Today I will be sharing a very simple strategy on how you can steer your tech investing strategy, because I had enough of all these rotation stocks because it will not give me life-changing money. Only disruptive tech stocks will help me with the gain for early retirement. Hi, welcome back family investors. Today is a very interesting topic. 2022 will be a very difficult year, at least the first half, to invest in tech stocks. We have to survive, we have to steer. I'm not a big fan of buying into these rotation stocks because the oil, the finance, the energy type sectors will not give me the gains that I expect from tech stocks in the long term. So today I will show you a very easy, simplified method to help you steer this through these difficult times. Before I begin, remember to click like and subscribe on this channel to help you in your investment journey, not just for last year but also the year 2022. And if you stay till the end, I will show you 16 tech stocks whether you should buy, hold or sell out of your portfolio and eventually beat the market for the year 2022. So let's start off with 3 key criteria for your filtering method. So the 3 key criteria is the TTM, the 12 months trailing method, revenue growth, and also the profit margin. This is different from last year, but these are the 3 key areas you need to look, because you have to put yourself as an institutional fund managers and be picky on what tech stocks to pick. So after that, I will show you 3 key categories. Category type 1 stock will be the ones to buy and hold dollar cost average, which will be low TTM, high revenue growth, good profit margin, perfect. But then if you can come to stage number 2 where you get TTM slightly higher between 15 and 40, that's okay as long as the revenue growth are still over 40%. They might not be having good profit margin, but anything above 15, there's room for improvement, great hold. But if you go to category 3 where you got a high TTM, under 25% growth and negative profit margin, please take it out of your portfolio right now. I'm not a financial advisor, but I tell you, take it out right now. Before I get into the stock, let me elaborate a bit more with this slide here. So type 1 type stocks, the category 1, the green light, the thumbs up, is you should buy more, dollar cost average more. It's a no-brainer. Buy trigger is an entire different game, but at least it helps you with the filtering technique. And if you go to number 2, the type number 2, it's one of those, you buy on the dip, buy the right trigger, don't rush in. Watch the earnings, whether the revenue is still growing, whether the sales are growing, profit margin is coming up, they bring in money, they're not impacted by interest rate hikes, then go for it. Potentially be your dark horse in your portfolio. And then now we go to type 3, which is the one that you should avoid. If you own them, I highly suggest that you risk transfer them and buy something else and hold something of a better quality. If the company doesn't make profit, if the company doesn't generate more higher revenue growth, high interest rates will really smack them on the face and lose their teeth. And before I show you the 16 stocks, again, a gentle reminder to hit and smash that thumbs like up button so it helps with the algo and other family investors will see this video and help them steer through their journey because it's worthwhile. So now, again, this is pre-Q4 2021 earnings, which will be happening in February, but I'm showing this list and it could change. So boom, there you go, straight on 16 stocks, and I will show you the indicator. Number 1, the green, the blue, and the red is the ones to avoid, which I see a little tick at the side. So Snowflake, minus 50% profit margin, they will not be making money. I would avoid them. High TTM, revenue growth is high, but it will take time for them to catch up. So I will avoid Snowflake. AMD, one of my biggest hold, no-brainer, high profit margin, high revenue growth, nice general TTM on the side. Unity, again, avoid because of minus 40 profit margin. Cloudflare, again, I would personally avoid because it's minus 60% profit margin and very high TTM. Shopify, on the other hand, I give it a good green thumbs up. TTM is healthy, coming down slowly, revenue growth still over 40%, and the profit margin is coming in 100%. They're still growing. Shopify is healthy. Buy trigger is a whole different story, but something to watch out for. CrowdStrike is on the blue, category 2. Because the TTM is 31 and hopefully the revenue growth keeps up sustained and hopefully they bring in more profit. Once they generate profit, this could be a turning point for CrowdStrike and folks will understand this is not overvalued no more. Nvidia, another no-brainer. I don't have to speak about it. My videos suggest it every single time. ChargePoint, minus 100%. Please avoid that. Tesla, again, another no-brainer. Green for me. Everything healthy. Lemonade, minus 186% on the profit margin. Ugh. Adobe, a nice one. Still growing. Very, very healthy. Twilio, I don't like it because of the minus 31. Unless they change it around, then I'll give them a blue. Now, Fiverr and Sophie, it looks pretty good. The one I need to watch out for Fiverr is the revenue growth. They need to be above 40%. And Sophie, they need to start making profit because it's all digital service. Followed by Coinbase. No. Well done, Coinbase. This is really shining out. Coinbase has got the extra X factor. But again, it's very correlated to the crypto market. SEA now dropping to the blue because of their profit margin minus 21. If they can turn it around this year with all the expansion, then I'll give them a potential green one. But for now, they are blue and I'm waiting for the next earnings and I still like the stock. There you go. Simple and easy method where you look at the TTM, revenue growth, and also the profit margin to help you decide. And I've provided 16 stocks. I hope you found that useful. If yes, leave a comment and tell me and I'll provide more. But for you patrons who've been supporting me, you'll be getting a new updated sheet this Thursday, 2 days from now, with more stocks. And there are a lot of green category ones in there, which will surprise you because it did surprise me when I did my investment thesis. Again, buy trigger is a whole different ballgame, but this is something that you need to start filtering the good, the bad, and the excellent related great stocks. Thank you very much. My name is Alex Koh and hope you've enjoyed this.
I hope you enjoyed that video. Check out our website link below. More videos up here.
Bye.
Bye.